Everyone, we are TAGPT, and first we would like to discuss crucial data we save for our stock prediction model. So in our first table, we save our stock data, and here in the stocks table, we have a symbol, a company name, a sector, and industry. And then next we go to the historical data table, which emphasizes the importance of date, open, high, low, close, and volume fields for understanding the market trends. And next we discuss the role of dividends. So we look at the dividends table and we know that company's financial health is good if the dividends are quite high, and it's good for long-term stock trends. And finally, financial data like the revenue, net income, assets, liabilities, and equity from the financial tables can enhance the model accuracy through fundamental analyses.
Alright, so this was all about the database schema. Now we'll talk how we created a command line interface. So firstly, we'll have to run a code called a file called python3 addstock.py. So we can add a portfolios table. So when we do that, you can see a portfolios table has been added to our database. Now we'll give the user a command line interface to add stocks. So when you run this command, you can actually see the various parameters that you can give to add or create a portfolio. So for example, I wanted to create a portfolio called retain, and I will use the create flag to create it. And after I've done that, let's just check if it was successfully added. So firstly, at the portfolios table, you can see there's a name of the portfolio and the creation date, and there's another table created by the name of written. So here we can add all the stocks, etc. So for example, if I wanted to add a stock here, so I can use the add flag, and then I can use the portfolio name that is retain, and then the stock name. So for example, I'm adding Apple first. Let's just add a Microsoft first. Oh yeah, so sorry, there has to be a double dash. Yeah, so as you can see, the stock was added. Let's just check if it was added in our database or not. So here, as you can see, the stock was added. Now for example, if I'm adding a invalid stock, suppose MS, FHU, anything, then my command line will throw an error. So it's just validating if it's a right symbol or not. And as you can see, it was not added to our database. Now let's just add one more stock. Let's add Apple to the portfolio, and if we refresh our Firefox, we can see that the symbol that the stock was successfully added. Now let's just remove our stock. So let's just remove Apple to show that the remove flag is working. And when we refresh the Firebase, as you can see that the Apple stock was removed. Now let's just create one more portfolio so that we can see the list of all portfolios. Suppose we'll create a portfolio called Jason, and then we add stock Google, and then as you can see, now when I use python3 command line py and the display flag, it should show me all the portfolios that we have and the stocks created in each portfolio. So as you can see, the portfolio, the date which was created, and the stocks. Now if you wanted to add another stock, which suppose portfolio Jason, now we can use the add flag, and then when you use the display flag again, we can see that the stock was carefully added, and we can see finally, which I feel the most important is like when we wanted to fetch some data for related to stock in our portfolio. So we'll use the fetch command, or we'll use the fetch flag. So here's the usage for the fetch flag. So firstly, just the command to run the file, then the fetch flag. Suppose we're gonna fetch it from portfolio JSON that we created, and then suppose the start date is 2022. It's in the format of year, month, and date. So let's go with 12 December till 2023. Let's go with 1st January. Let's go with 2023 and 2024 till 22nd of January. Yeah, and let's just run this. So as you can see, when we run this command, we get the accurate data, or we get the adjustment close, high, low, open, volume, and the same for the stock Google. So for it in date range, we can see the data that we required. All right, now we'll focus on the pre-processing table. So firstly, we download the CSV version of the data set by just going to historical data and then export, and then as CSV, and then we save it on a local machine. And then afterwards, once we have our historical data, which we modify to just contain the stock prices for now for 4 companies, which are Apple, Amazon, Google, and Microsoft. And so if you wanted to run the data processing file, we need to run a certain command, and that the certain command is and then the certain command is the file called data processing. It's DSCI data processing. So it's Python 3 DSCI data processing.py, and then the stock name for which we have to pre-process for. So here we are pre-processing it for Apple, and here as you can see, this is all after pre-processing. We have imputed the null values with 0, and we have also calculated some things like yeah, so we have also calculated something called as a daily returns. So daily returns measure the percentage change in a stock's price from one trading day to the next. So how is this useful? It provides insights into the short-term price movements of a stock. It also helps in analyzing historical daily returns, helps in identifying trends, patterns, and volatility in stock prices. By understanding that how a stock's price has fluctuated in the past, investors can make more informed decisions about potential future price movements. Secondly, we have calculated something called as moving averages. Now, moving averages smooth out price data by calculating the average price of a stock over a specified period. So now we have only selected 10 days and 50 days. And they also help us to identify trends and reversals in stock prices. They provide a clearer picture of the underlying direction of a stock price movement by filtering out short-term fluctuations. And so sometimes there can be crossovers between different moving averages, and they can signal potential changes in trend direction. Finally, we've calculated volatility and RSI. So what is volatility? It measures the degree of variation in a stock's price over time, and it is usually calculated as a standard deviation of daily returns over a specified period. And what is this the benefit? So it reflects the level of uncertainty or risk associated with a stock. So if there is higher volatility, it implies greater price fluctuations, which can present both opportunities and risks for investors. And what does RSI do? So RSI is a momentum oscillator that measures the speed and change of price movements. It can oscillate between 0 and 100 and is typically used to identify overbought or oversold condition in a security. A higher RSI value typically indicates that a security is overbought, meaning that it may be due for a price correction or reversal. Conversely, a lower RSI value suggests that a security is oversold, indicating a potential buying opportunity. So this was all for our lab 3. Thank you so much.